Hello, ladies and gentlemen. This is Sylvia of CPDbox.com. Welcome to this video with my answer to one of your questions. If you have your own questions that you want me to respond, then send it to me via our website. And if it's useful for many people, I will answer it in a video like this one. Today's question comes from Junik from Singapore, and here we go. Hi Sylvia, I would like your help on fixed assets useful lives. We have a head office in Singapore and subsidiaries in various countries. The headquarters of the parent company set the useful life of the property, plant and equipment for the whole group, and subsidiaries have to depreciate their property, plant and equipment over these useful lives set by the parent. But individual countries have their own laws or rules on the useful lives that are not the same as what the parent company prescribes. Also, auditors of the subsidiary insist on using useful lives in line with the parent's policy. How can this be handled in the financial statements? I'm not sure how to handle this, and your advice will be well appreciated. Looking forward to hear from you, Junik. This is again great question because it happens on a regular basis, and many companies within the same group use different useful lives of their assets. And auditors insist on depreciating these assets over uniform useful lives throughout the group. Well, I personally don't like it. Yes, it is very practical to write in the consolidated notes that, okay, we are depreciating our machines over 10 years, our cars over 4 years, and our buildings over 40 years. And the reader knows that whether it's a building in Spain or Singapore, it will be depreciated over 40 years. That's very practical, no dispute on it. But the standard IAS 16 says that the useful life of an asset is determined based on expected utility of that asset to an entity. Well, just look at the definition of the useful life in IAS 16, I think paragraph 6. It is either a period over which an asset is expected to be available for use by an entity, or number of production or similar units expected to be obtained by that entity from that asset. So the useful life is specific to the individual asset and individual entity. Well, it is well possible that a parent can use the same type of asset for a longer period than its subsidiary. Well, and as a result, both can apply different useful lives. Well, just imagine one subsidiary operating in northern Canada and the other one operating in, let's say, India. Totally different climates. One is cold, one is warm. Well, they bought the same drilling machine that will operate outside. It is quite probable that the subsidiary in Canada will use the same machine for the shorter time than the company in India, just because the temperatures are much lower, the ground is harder, and the drilling machine would be consumed earlier than the one in Indian warm weather. So it's normal in this case to have different useful lives for the same assets. And if you work for the group that does not have the same useful life for each subsidiary, then I guess it's okay. Okay. I can hear you saying, but when you consolidate, IFRS 10 says that the companies within the group must apply the same accounting policies. Yes, that is true. But the useful life is not an accounting policy. It is accounting estimate, and it is specific for each company and each asset, I would say. So it's okay to apply different accounting estimates based on the specifics of that company. Well, yes, but in practice, it is very common that a parent prescribes the useful lives of all assets within the group, and although it might not fully reflect the reality, it is okay and widely accepted practice. So what to do when the local useful lives or depreciation rates are different for tax purposes than the group rate? Well, there are several solutions possible. Number 1, subsidiary would depreciate its property, plant and equipment over the same useful lives as its parent in its own local accounting records. So here, if the tax depreciation rules are different, well, subsidiary will recognize deferred tax. That's logic because the carrying amount of assets would be different than its tax base. Solution number 2. In its local accounting books, the subsidiary would depreciate the property, plant, and equipment over the useful life as prescribed by the local legislation. And normally subsidiaries submit their financial statements to the parent company in form of reporting package or consolidation package that contains the statement of financial position, profit or loss, intra-group balances, and other information. When subsidiary prepares that reporting package for the consolidation purposes, it will make the adjustment to align useful lives with the group's policy, and again, the deferred tax would be required in that consolidation package. So either subsidiary makes adjustment in its local books or in the consolidation package. The third possibility is that the parent can make the adjustment when consolidating everything. But if the parent owns a number of subsidiaries, this would be extremely demanding and challenging to keep track on adjustments of every single subsidiary. Well, the easiest approach is probably the first one, when the subsidiary just applies the group's rates in its own local accounting books and makes the adjustment for the deferred taxation. Yes, I said earlier that in this case, property, plant, and equipment might not reflect the subsidiary's own reality. Well, but if the subsidiary doesn't need to submit the financial statements to some public market, stock exchange, and reports just to tax office and to the parent, then it would probably be okay and acceptable. But if the subsidiary is big enough and its shares or other instruments are traded publicly on the stock exchange, or simply subsidiary needs to share its financial statements with a wide range of users, then I would go for the second option and make adjustment in the consolidation or reporting package so that the individual financial statements of that subsidiary would reflect reality better. So let's see this in an illustration. Subsidiary acquired a building with a cost of 120,000 currency units. Local tax legislation prescribes to depreciate buildings straight line over 40 years, but the group's policy is to use the buildings for 30 years. Ignore residual value. Tax rate in subsidiary's country is 20%. So the first approach is that the subsidiary depreciates the building over 30 years exactly as its parent. So total annual depreciation is then a cost of 120,000 divided by 30, which is 4,000 currency units. The carrying amount at the end of the year 1 is therefore 120,000 less 4,000, which is 116,000. But for tax purposes, it's possible to deduct 120,000 divided by 40, which is 3,000. And the tax base at the end of year 1 is 120,000 less 3,000, which is 117,000. And you can see that the tax base is different than the carrying amount. And thus we have a deferred tax, which is a difference of 1,000 multiplied with a tax rate of 20. And that's 200, and that's deferred tax asset in this case. Now, in subsidiaries' individual financial statements, there are two journal entries. One is for depreciation, so we debit accounting depreciation in profit or loss with 4,000, and we credit accumulated depreciation of property, plant, and equipment with the same amount. And we also need to account for deferred tax asset in this case, so we debit deferred tax asset with 200 and credit profit or loss, deferred income tax charge or income in this case of 200. And there is no need to make any consolidation adjustment because it's okay and in line with the group rules. The second approach is that the subsidiary depreciates the building in line with the local legislation. So the annual depreciation will be 120,000 divided by 40, which is 3,000. It's the same for tax and for accounting purposes. And the carrying amount at year end is 117,000, right? 120,000 less 4,000. So as I said, tax depreciation is the same. Tax base is the same as carrying amount, and no deferred tax arises in the local subsidiaries books. Now, there is only one journal entry in the subsidiary's individual financial statements. Debit depreciation in profit or loss with 3,000 this time, and credit property, plant and equipment accumulated depreciation with the same amount. When making consolidation, consolidating adjustment will be made in the group's financial statements. So first, we need to align the depreciation with the group rate. So we debit depreciation with a difference of 1,000 and credit property, plant and equipment with 1,000. 1,000 is 4,000 less 3,000, right? And we also need to account for the deferred tax on adjustment. So we debit deferred tax asset with 200 and credit deferred income with 200, which is a difference of 1,000 multiplied with 20% of the tax rate. So from this illustration, it's clear that from the group's view, it's easier to use the same accounting estimates with solution 1 and to reduce the amount of adjustments and journal entries in the consolidation. If you would like to see the notes of this video with the example solved, I added the link below, so make sure you check that out. Now, usual disclaimer, this information is not a substitute from a professional judgment of CPA of your own situation and circumstances, and you should consult CPA and other qualified professional. That's it for this video. I hope it helped. Please share it with your friends or colleagues who can benefit from this knowledge, because as you know, sharing is caring. Make sure you subscribe to our channel and to our free newsletter at CPDbox.com. You'll receive lots of news, useful emails, and stay tuned. Bye-bye, and thanks for watching.